Okay, hi everyone. This is going to be the problems for chapter 11. Looks like we have 3 exercises here, and then a little bit larger problem, problem 11-17. Okay, so the first one here, right, it looks like we have a service company, a division of a major oil company, so we have a division, and they provide various services to the operations of the North Slope oil field in Alaska. Data concerning the most recent year appear below. Looks like they're giving us sales, they're giving us net operating income, and then they're giving us our average operating assets. Okay, and a few things here they want from us, right? So they want the margin, they want the turnover, and they want return on investment. Okay, so the first one, right, they ask, can you please compute the margin? Right, so the margin in this case, M-A-R-G-I-N, okay, that's going to equal your net operating income divided by your sales. So what we'll do in this case, right, we'll take this net operating income of 600,000 and we'll divide that by our sales of 7,500,000. And that's going to get us a margin in this case of 8%. Okay, so the answer to 1, the margin is going to be 8%. 2, looks like they want turnover, right? So the equation for turnover is going to be equal to your sales divided by your average operating assets. Right, so if this was 1, let's kind of circumscribe that there. 2 for turnover, if we plug the information here, so our sales are 7,500,000, and our average operating assets in this case from over here are 5 million. Okay. So with that, right, the turnover is going to be 1.5. Nothing too hard so far. 3 here, they want ROI, right, return on investment, which is going to be in a couple different ways you can calculate it. How we're going to do it here is we're going to take our margin times our turnover. Right, so we have our margin of 8%, and then we're going to have our turnover of 1.5. So if we do the 8% times 1.5, we're looking at an ROI here, or return on investment, of 12%. Okay? And let me just kind of circumscribe that there. So we did 1, 2, and 3. All right, let's move on to exercise 11.2. So they're saying we have Juniper Design Limited of Manchester, England. They provide design services to their residential developers. Last year, the company had net operating income of $600,000 on sales of $3 million. The company's average operating assets for the year were $2.8 million, and its minimum required rate of return was 18%. They want us to calculate the residual income for the year. Okay? So what we're going to do here, right, to calculate it, right, we're going to take, so the equation here, our residual income, this is going to equal our net operating income minus, in this case, it's going to be our minimum required rate of return. Essentially what we do is our average operating assets times the minimum required rate of return. Okay? So based off what they're telling us up here, right, it looks like they had net operating income of $600,000. Right, so $600,000 right here. Looks like they had sales of $3 million, and the company's average operating assets for the year were $2.8 million. Right, 2.8 million, and its minimum required rate of return was 18%. Okay, times 18%. So if we do those parentheses first, that looks like that's going to give us 504,000 right here. Right, so if you do 600,000 minus 504,000, your residual income is going to be $96,000, right? So the idea here is your residual income is in dollars, whereas we go back over here and your ROI is in a percentage. Okay, so let's look at 11.3 in this case. And let me kind of zoom in here. All right, so we have a company here, and it looks like their audio division produces a speaker that's used by manufacturers of various audio products. Sales and cost data on the speaker is as follows. Right, so it looks like the selling price per unit on the intermediary market is $60. Its variable cost per unit is $42. Fixed cost per unit based on the capacity is $8. And then the capacity in units is 25,000. All right, so it looks like they have a hi-fi division that could use the speaker. All right, so we're potentially talking here about the audio division selling it to the hi-fi division. And it looks like that hi-fi division, they're going to need 5,000 speakers per year, and they've received a quote of $57 per speaker from another manufacturer, from like the outside market. Okay, so Sacco Company evaluates division managers on the basis of divisional profits. So it says in this case, assume the audio division, right, sells only 20,000 speakers per year to the outside customers. Based on that fact, right, they want to know a few different items here. So A says, from the standpoint of audio division, yellow right here, what is the lowest acceptable transfer price for the speakers to be sold to the hi-fi division? Right, so what we're going to have here, right, if you remember from the PowerPoint, we're going to have our transfer price in this case is going to be greater than or equal to basically the variable cost per unit plus the total contribution margin on lost sales divided by the number of units transferred. Let me move that out. Okay. All right, now in this case, right, the idea with it is because there's enough idle capacity to fill the entire order from the hi-fi division. In other words, we're at 20, our max is 25. We can fill that, right? We're not losing out on any other sales. No outside sales are lost, okay? So for basically the denominator over here, we're going to have $0. We can fill this with no problem. We're not missing out on any other sales. Now, likewise, because the variable cost per unit, what they tell us over here, it's 42 bucks, right? The lowest acceptable transfer price as far as the selling division is going to be concerned is also $42, right? In other words, if you plugged in the information here, it would be $0 over the 5,000 units we have to transfer. We have $42, our variable cost per unit. Right, the transfer price when you do the math on that, right, it's going to be $42. In other words, the lowest acceptable price when you fill in the equation is 42 bucks that they're going to accept. All right, let's look at B here. It says, from the standpoint of hi-fi division, the green guy, right, the ones who are buying, what is the highest acceptable transfer price for the speakers acquired from the audio division? Right, so for B over here, right, so let me draw a line. Right, so that was looking from the seller, now we're looking from the buyer. The equation here is going to be, right, you have the transfer price. This has to be less than or equal to the cost from buying from an outside buyer or an outside supplier. So sorry if you can't read that, I'll just read it out loud. The cost from buying from an outside supplier. In other words, the buyer, when they're looking at this situation, right, they're not going to pay more than what it costs to buy from somebody else, right? So if you're going to sell it to me, you know, if I can buy it from 10 bucks for that guy, you know, in that case, right, I'm not going to pay any more than 10 bucks to you, right? Because I can get it from that guy for 10 bucks. So in this case, right, if we go back to the facts here, it says, let's see here, they can get it from somebody else for $57. All right, so that's the answer for B. When it says from the standpoint of hi-fi division, what's the highest acceptable price they'd be willing to pay from the audio division? Well, the maximum price here the buyer would be willing to pay to the seller is $57, up to but not beyond what they could get it on the open market. Okay. All right, so C here, it says, what is the range of acceptable transfer prices, if any, between the two divisions? If left free to negotiate without interference, would you expect the division managers to voluntarily agree to a transfer price of 5,000 speakers? Why or why not? Okay, so basically, in this case, what we have to do is kind of combine these two items over here. Right, we have the 42 bucks, which would be the minimum that the seller would be willing to take. And then we have the 57 bucks, which would be the maximum that the buyer would be willing to pay. Right, so if we kind of plug that in over here, right, so we'll do C right here. Right, so we have $42, okay, and it's got to be less than or equal. We'll have the transfer price here. And then we're going to have less than or equal to $57. Right, so I think we made, let's see here. This one blue, and this one green. In other words, that area in between here, right, that would be the range of the acceptable prices. It makes sense for each of the parties, right? The seller, they're not going to lose money. The buyer, they're not going to pay more than what they would do on the open market. So given that we have this window, right, roughly what, like a $15 window here, 42 to 57, assuming the managers understand their business, they're cooperative, they're willing to work together, it's likely that a transfer price could make sense here, right? I would expect the sale to happen given that we have this window, okay? Let's look here at D. It says, from the standpoint of the entire company, should the transfer price take place, why or why not? All right, so D. All right, so the idea is yes. It should take place, right? The idea here is the cost of the speakers transferred is only $42, and the company saves the $57 cost of the speaker purchased from the outside supplier. In other words, if we can buy it for cheaper internally, we'll still, make a little bit of a profit from the seller, and the division that's buying it's going to be able to buy it cheaper. Hey, that's a good thing overall for the company, right? They have excess capacity. They can do it. They can make it. And the people who are buying it, they're going to spend less than what they would on the open market. Okay, so let's move on to problem 1117 here. This one's going to take a little bit of time to write it out. So they're giving us some information. They're saying financial data for Jewel de Paris Inc. for the last year as follows. Right, so they're giving us a balance sheet. Then they're giving us an income statement. And they said down here the company paid dividends of $15,000 last year. The investment in Busan SA on the balance sheet represents an investment in the stock of another company. Okay, so let's see. Let's just highlight that or make it. We can put a little star here, and if we find it, okay. Yep, this is just saying that hey, this is an asset, that an investment we have in another company. And then it says the company's minimum required rate of return is 15%. Okay. So, okay, when we look at this, they're giving us three different things here. The first one is they want the company's average operating assets for last year. Okay, so we can do this, right? We'll go over to the balance sheet here, and what we're going to do is we're going to snag these balances, right? Because the idea when you're looking at your operating assets here, your average, it's going to be your your beginning plus your ending divided by 2, right? So basically when we look at all of these and we're trying to classify our operating assets, right, it's not going to be our total assets, it's just those we use in our operations, right? So it's going to be our cash, our accounts receivable, our inventory, and our PP&E, okay? So with these guys, let's kind of build this out over here, right? We're trying to find our average operating assets. And basically the thing is, what we use in operations, we have identified them. The other items on there, things like investments in other companies and undeveloped land, it's not really an operating asset, okay? So we have, right, our cash. We have our accounts receivable. We have our inventory. And we have our property, plant, and equipment, right? That's going to be net of accumulated depreciation. And essentially with this, right, we'll have our beginning balances and we'll have our ending balances, right? So our beginning and our ending, we'll just enter those numbers in across the board here, right? So cash, looks like our beginning was 140,000. Our accounts receivable, we had beginning of 450,000. Our inventory was 320,000. And our PP&E was 680,000. Right, so the idea is with those, when we add them up, right, we're going to have our total operating assets in the beginning of the year of what, 1,590, 1, 2, 3 zeros there. All right, so for the end of year, again, we're just going to take these numbers from over there. We got 120,000. We got 530,000. We have 380,000. And then we have 620,000. Okay, we add those up. It's going to be 1,650. All right, so we have beginning of 1,590,000. And we have ending there of 1,650. Right, and again, just keep in mind, what are they asking us here? We're trying to figure out our average operating assets. Right, so our average operating assets, they're going to equal, so we'll take, in this case, the 1590 from up there. Right, our beginning plus our ending, right, of 1650. And basically, that's just, the 1590 and the 1650, if you're wondering where we get those. And we're going to divide that by 2, right, to get our average amount. So when you do the math on that, right, the 1590 plus the 1650 divided by 2, you're looking at average operating assets of 1,620,000. Okay, so let's go back here. All right, so we did one. We figured out the company's average operating assets. Now, what they want us to do is, can you please calculate the company's margin, the turnover, and the return on investments? And it says, hint, you should use net income or the net operating income in your calculations. Which one should you use? On this one, right, we want to be making sure that we use net operating income. Okay, so let's start with that. We have basically 3 things we have to calculate here. Right, so for 2, we got to figure out margin, turnover, and return on investment. Right, so margin, we just saw this a little bit ago. That's going to equal your net operating income divided by your sales. And we know our sales right here are 4050. Okay, so we can put that down here as the denominator. And if we go up, right, we have to make sure we use net operating income, right? That's before interest and tax expense, right? It would be a mistake to use net income. They sound the same, but they're different because one is the net operating income, whereas the other is going to be the full net income. All right, so we'll take the 405,000 divided by that 4,050,000. We're looking at a margin here of 10%. Okay, did the margin. That's great. Let's move on now to turnover. Okay. Now we saw turnover before, right? So that's going to be your sales over your average operating assets. Okay, so our sales we can grab from up there, right? It's that 4 million number. We just saw that. So that's going to be 4,050,000. Okay. And then our average operating assets right? That's this 1620. That's what we calculated in A, right? Or in 1 up here where we did our beginning plus our ending divided by 2. So we have 1620 there. Okay, so let's do 1,006,20. So when we run the numbers on that, right, our sales over our average operating assets, we're looking at it here of 2.5 for our turnover. All right, third one they want us to do is ROI, right? And this one is going to be your margin times your turnover. Now our margin from up here is 10%, okay? And our turnover is 2.5. Right, so that's going to give us an ROI here of 25%. Okay, so take a minute, right? You can run through how we got that, right? We did our margin, then we did our turnover, then we did our ROI. All right, third one here, right? They want to know what was the company's residual income last year. Right, now in this case, right, we looked at it, it's going to be our net operating income, and then it's going to be, let's see here, minus, right, so if we go back here, it's going to be our average operating assets times our minimum required rate of return. Times our minimum required rate of return. All right, so let's go up. Let's see what we can snag from up here, right? Our net operating income is that 405,000. We've used that a couple times so far. Right, so we'll have 405,000. And then in this case, right, our average operating assets, let's see, we can grab that from up here. 1620, okay. All right, so that's going to be 1,620,000. And then our minimum required rate of return, right, let's see, paid dividends. Okay, here we go. Minimum required rate of return is 15%. All right, so with this, right, if we solve in the like the parentheses, there's 1620 times 15%. That's gonna be 243,000. Right over here, our net operating income, we'll just carry that down. Right, when you do the 405 minus the 243, you're going to be looking at 162,000 of residual. income. Let me kind of bracket this off here so you can look at it again to see how we did that. So just to run through again, this problem, right? We did average operating assets up here first. Oops. Kind of step one. Then we did our margin. We did our turnover. We did our ROI. And then we did our residual income. Right, so it's a variety of different calculations we had to do here. We worked through these one or two times, and then we looked at, another important part of this chapter was transfer pricing. Right, we said the idea with transfer pricing is basically you have two divisions within a company, and they're trying to sell a product or services from one division to another division. And what we have to do internally to the company is figure out, hey, what price makes sense, right? We want to avoid this thing called sub-optimization, right? The idea that managers may look out for their best interests for their particular division, right? They don't want to sell it for less than X or more than Y, and the people who are buying it don't want to pay, more than Z, whatever the case is, right? But what we have to do is kind of take a step back, look at everything and say, hey, what makes sense here? What's the minimum amount or the minimum price that the buyer is willing to sell it for? We have this formula up here. In this case, right, we had $0 of lost contribution margin on sales. We're at full capacity, right? We can fill this. Be a little bit different setup if we had some or no capacity. That would change this dynamic. And that basically says what's the minimum they're willing to sell it for. And then we ran the numbers for what is the maximum the other party, the ones buying the goods, what they're willing to pay for it. Again, what they do there is they look to the external market. I'm not going to pay you more for this product than what it would cost me on the open market. That would be kind of silly in that situation. I'm not going to pay you more than that. And then what you do here, right, in between those two items, right, the minimum amount the seller is willing to sell it for and the maximum amount that the buyer is willing to pay for it, this right here is called the range of acceptable prices, right? This is where both parties, it makes sense for them to do it, right? Because they're going to want to sell it for more than it costs them. The selling division, they make some profit. And the buying division, they're going to be able to buy it for cheaper than what it would cost on the outside market, so they win as well. The sellers, right, we have this idle capacity. We might as well make it. We can do it. It's not going to cost us money. We can maybe get a marginal incremental profit on it. And again, the buyers, hey, we get a better price than what we pay on the open market. So I don't know, maybe they agree to a price here of $50, $43, $44, right? Anything in between those two makes sense for each of the parties, but anything outside of those two does not make sense. In other words, $40 wouldn't cut it, right? That wouldn't make sense for the sellers because they're losing money. Likewise, right, $60 isn't going to make sense either, right? We're not going to pay $60 when we can buy it from someone else for $57, right? So this is the range of where it makes sense. That's what they mean by acceptable prices. So with that, right, we're just running through some examples here, giving some numbers to the definitions, the terms. We will, end the problems here. This should be sufficient to help you with some of the homework questions, and we'll see you in the next lecture.